As you explained that Alder follows a benchmark portfolio and divides it into like 4 different categories. If you could explain each category giving an example, and also is there a mix that you follow, like a 25% mix for each of these categories? How do you decide category weight versus stock weight, and overall what is the number of stocks that you have typically in a portfolio?
So we look at the portfolio from multiple angles. One, there are businesses which, like you said, there are different competitive advantages, and in competitive advantages, one being the production advantage. Like a DMart has got serious amount of scale advantage, wherein it is able to do an everyday low pricing, pass this on to the customers, and therein it creates a positive feedback loop where customers walk in and there's more revenue achieved per square feet than any other retailer possible, right? So we break these businesses down into that. Network effects are those businesses which are consumer tech platform businesses, right? Where you have as more users join the network, the existing users gain out of it, right? There are many plays like your Paytms and Zomatos of the world, including Nykaa to a certain extent, which fall into this category, right? We look at these businesses where they fall in. Like brand businesses are essentially consumer discretionary businesses like Tanishq. It could be like a Bata and Relaxo. It could be anything from consumer staples, which could be Unilever, Nestle's of the world. These are brands which fall into that category where a customer is seeking to attach himself to some desirable association, right? And once that happens, the brand equity of goes up, and these brands tend to keep layering themselves with additional products and services as the case may be, and scale the business in that sense. So when we allocate assets, we do not define saying it has to be 20% here and 30% there. We are seeking businesses which fall into either one of these categories. At a given point of time, we might get some investment which is ticking all the boxes, fits our valuation criteria, seems like it could be a high return on a 5-year period, because that's how we analyze businesses, not on a 1-year basis, and then we allocate. But we just try to make sure that there is no excessive skew on one direction, right? And there's some amount of balance which has been created. In terms of stock weightages, we have another classification. We call businesses as Incredibles, Core, and General. So what we look at is if this is some kind of a business where the advantage is so huge and it cannot be displaced by an existing player or a new entrant, and it's so possible that this business can grow well ahead of the category and the markets, then in that case we would like to invest serious amount of money into this business, which could be at the extent of 10% of a portfolio, right? We call these incredible businesses. The tenure of holding these incredible businesses will be much longer, right? Even beyond 5 years. There are some stocks that we own today for 4 years and beyond, that constitutes roughly around 60% of our assets right now. Then there are another set of businesses which we call as core. This is something where we want to hold for maybe 3 to 5 years, and we would invest somewhere around 7.5% of the portfolio at the top end, right? Then we have a third category which is called as generals, where we feel that there are certain risk criteria where it doesn't tick all the boxes, where we need to evaluate as the business grows before deploying serious money. So in these businesses, we might invest anywhere between 3 to 5%. That's how we size our portfolio up. And for any fine reason, we would not exceed more than 18 stocks in any individual client's portfolio, or even for Alder Capital as a whole. And at the bottom end, we have gone all the way down to even 10 stocks, right? But again, it's dependent on market situations. If we have the opportunities, right, and we would love to see we get many opportunities to invest in, which have got high IRRs over a long period of time, then obviously we will build a little larger portfolio than just having 10 stocks. So on an average basis, around 14 to 15 stocks is where we typically are at for individual portfolios.
If I were to correctly reiterate and summarize what just sir explained, is that while Alder focuses on 4 categories while it goes for building a portfolio, and those 4 categories are production advantage, brand, higher switching cost for consumers, and networking effect. While they decide how much weight to give to a certain stock, they have three categories, which is Incredibles, Core, or General. And Incredibles would typically have like a 10% weight. The Core might attract a 7% weight, and the General might attract 3 to 5% weight. And typically a portfolio would have at max 18, max 19 stocks, and depending on opportunity, they might make it slightly more concentrated or again go back to the normal, which depends on market condition.